All right, let's talk about Northpointe Bank. They just dropped their latest earnings report and bam, the stock took a hit right away. But here's the question. Did the market get it right, or is there more to the story? We're going to dig into their Q4 numbers and figure out what's really going on. Let's jump in.
So, here's our game plan. We'll start with the headline numbers, then get into the story behind that earnings miss. After that, we'll cover their growth playbook for 2026, and we'll wrap up with our take on what's next.
Okay, first up, the headline. And honestly, it was a bit of a head-scratcher. When Northpointe's report came out on January 21st, it really sent some mixed signals to the market.
So here's what everyone saw. On one side, you've got a revenue beat. That's the top line, right? They brought in more cash than Wall Street was looking for. But then you look at the other side and, oops, an EPS miss. That's the bottom line, the actual profit. And when you get a beat on one and a miss on the other, you're pretty much guaranteed to see some confusion.
And well, how did the market react? Pretty much how you'd expect. The stock gapped down 2.6% right at the opening bell. The gut reaction was definitely negative. It was a classic case of traders hitting the sell button first and figuring out the details later.
But you know, the headline is almost never the whole story. So let's peel back the onion here and see what was really going on behind that gap miss.
This is the big question, right? It's what every investor was asking. If they're making more money on the top line, why are profits down? Is something wrong with the core business, or is it something else?
And here it is. The culprit was a one-time charge of $3.2 million. Now, this wasn't some slip-up in their day-to-day banking operations. No, this was a deliberate, strategic move to redeem some preferred stock and basically clean up their capital structure for the long haul. Now, this is the kicker. If you just pull that one-time charge out of the equation, the entire story flips on its head. Their earnings per share would have been 61 cents, and guess what? That's a beat. So what looked like a failure on the surface was actually covering up some really solid performance.
And when you look at the core business, it looks pretty darn strong. Take their net interest income. That's basically a bank's bread and butter, their main profit engine. It grew nicely from Q3 to Q4. That's not what a struggling company looks like. That's what momentum looks like.
Yeah, and the other vital signs for the bank are looking fantastic too. Their net interest margin, think of it as their profitability on loans. It actually got bigger. Plus, both their total assets and total deposits grew by a ton year over year. I mean, these are all textbook signs of a healthy, growing bank.
And you don't have to take my word for it. The CEO, Chuck Williams, said it himself on the earnings call. He talked about robust balance sheet growth and consistent earnings. It's pretty clear that management's head is in the right place. They're focused on the real business momentum, not some one-off accounting item.
All right, so that's the what happened. Now let's talk about what's next. Management gave us a really clear look at their playbook for 2026, and the key word here is focus.
The strategy is actually pretty simple, which I love. They're basically doubling down on their two big winners, scaling up their mortgage purchase program and growing their all-in-one loans. And everything else, they're just going to let those portfolios run off. It's all about putting their time, money, and energy where it counts the most.
And they're not just talking a big game. They put hard numbers on it. This is their guidance for 2026. They're telling us they expect that net interest margin to stay really healthy, and they've set some ambitious but clear targets for growth in those key loan programs. This is great because it gives us, as investors, a clear report card to grade them on.
The Q&A part of the call also gave us some important context. We learned they're already expecting higher FDIC insurance costs. They're also assuming the Fed cuts rates twice next year. And interestingly, they said the recent roller coaster in mortgage rates hasn't really shaken their confidence, and they feel really good about the quality of their loans.
Okay, so we've looked at the numbers and we've heard from management. Now for the big question, what does it all mean? Let's pull all this together into our take on the stock.
And before I give you our rating, just a quick bit of housekeeping. When you hear us say outperform, it's our way of saying we expect this stock to beat the broader market. It's our most positive rating.
So here's the bull case, point by point. First, that so-called miss was just noise. It was a strategic choice, not a business problem. Second, their core growth areas are actually speeding up. Third, management gave us clear, confident guidance for the year ahead. And finally, that initial stock drop, it looks like a total overreaction.
And hey, it's not just us saying this. After the earnings call, the analysts over at KBW raised their price target on the stock to $22, and they also have an outperform rating. That's a pretty strong vote of confidence from others who are also looking past that messy headline.
Okay, so looking forward to the next quarter, what are the key things you should be watching for? What's going to tell us if this bull case is playing out?
Here's your checklist for the Q1 report.
Number 1, are they hitting those growth targets for their MPP and AIO loans? Number 2, is their net interest margin holding steady in that 2.55 to 2.55% range they guided for? And number 3, how are they doing on bringing in digital deposits to keep their costs down? If they can check those 3 boxes, things are looking good.
So putting it all together, our official rating on Northpointe Bank is outperform. We think the market simply misread the tea leaves here, mistaking a smart financial move for a business stumble. That to us looks like an opportunity. The core business is strong, and their plan for growth is crystal clear. Of course, this is not financial advice.